Listen carefully. Picture this. Margaret Holloway, 71 years old, a retired schoolteacher from Dayton, Ohio, 41 years in the classroom, a paid-off three-bedroom house on Maple Avenue, a husband she buried 14 months ago, and a yellow legal pad on her kitchen table where she still writes her grocery list in cursive the way her mother taught her. It's a Tuesday morning, October. The coffee is still hot, the radio is playing softly in the background, and then the mail carrier knocks. Because this letter requires a signature, certified mail, return receipt requested, from the State of Ohio Department of Medicaid. Margaret signs with a hand that suddenly will not stop shaking. She walks back to the kitchen, she sits down, she puts on her reading glasses, and she opens the envelope. The letter is 2 pages long. The language is cold, bureaucratic, surgical. It informs her that her late husband Walter, who spent the last 22 months of his life in a nursing home in Kettering, received $312,847 in Medicaid long-term care benefits before he died. And now the state of Ohio wants it back. All of it. From her, from the house, from the accounts Walter left behind, from the small inheritance her daughter was supposed to receive. The letter has a name, Medicaid Estate Recovery Program, MERP, authorized under federal law, OBRA 1993, Section 1917 of the Social Security Act, mandatory in every single state in the Union. Margaret reads the letter 3 times. She does not cry, not yet. She just keeps staring at one sentence near the bottom of page 2. A lien may be placed on real property owned by the deceased recipient or the surviving spouse. The house. The house Walter built additions onto with his own hands. The house where she raised 3 children. The house she promised her grandchildren they would inherit one day. The state wants it. And here is the part that should make you furious. Margaret did everything right. She paid her taxes. She saved. She never took a dime she didn't earn. When Walter got sick, the social worker at the hospital looked her in the eyes and said the 7 words that destroy more middle-class families in this country than any stock market crash. Don't worry, Medicaid will pay for it. Nobody told her about the 5-year look-back. Nobody told her about MERP. Nobody told her that the accounts they owned together, the ones she thought were untouchable, were already being counted, tracked, and flagged the moment Walter walked through the nursing home door. This is not a glitch. This is a feature, not a bug. The system is counting on your confusion. And tonight, I am going to show you the exact 5 accounts the state hunts first. The exact 60-month clock that is already ticking on someone you love. And the exact legal moves that stop the bleeding before the certified letter arrives at your kitchen table. Because Margaret's story is not rare. It is the blueprint. And it is coming for someone watching this video right now. This is the trap. This is the crime scene. And that is only the first layer. Let me tell you who the real villain is. It is not the nursing home. It is not the doctor. It is not even the social worker who told Margaret not to worry. The villain is a federal state machine built on a single quiet rule that almost nobody explains to you in plain English until it is far, far too late. That rule is called the Medicaid 5-year look-back. Here is how it actually works. The moment you apply for Medicaid long-term care benefits, the kind that pay for a nursing home, the state pulls 60 months of your financial history. Every account, every transfer, every gift, every check you wrote to a grandchild for college, every dollar you moved into a trust, every penny you handed your daughter to help with her mortgage. If they find a transfer they don't like, they don't reject you outright. They do something worse. They impose what is called a penalty period, a window of time during which Medicaid will not pay $1 single of your nursing home bill. And during that window, the bill keeps coming. $9,000 a month, $11,000 a month, $14,000 a month in some states. Who pays it? You do, out of the very accounts you were trying to protect. And when you die, MERP, the Medicaid Estate Recovery Program, comes for whatever is left. The house, the brokerage account, the IRA, the car, the land in the country your father left you. All of it is legally fair game in 50 states because federal law requires every state to run a recovery program. Some states recover only from probate assets. Other states, Ohio for example, chase everything they can legally reach, including jointly held property and life estates created within the look-back window. This should make you furious. You worked, you saved, you followed every rule, and the system was quietly designed so that the last 22 months of your spouse's life can erase 40 years of your discipline. This is not an accident. This is policy. OBRA 1993 made estate recovery mandatory. The Deficit Reduction Act of 2005 extended the look-back from 36 months to 60 months and tightened transfer rules. Every Congress since has had the chance to fix it. None of them have. Because the system saves states billions of dollars a year by clawing back from middle-class families who are too trusting, too late, or too uninformed to plan. The wealthy already know this. Their elder law attorneys set up irrevocable trusts a decade before anyone gets sick. The poor are protected because they have nothing to take. It is the middle class, homeowners with paid-off houses, retirees with $200,000 to $800,000 in savings, widows sitting on their husband's IRA, who get gutted. That is who this video is for. So before I show you the 5 accounts the state hunts first, I need you to do 3 things right now. Smash that like button. I am not asking, I am telling you. Every like pushes this warning to one more retiree who has never heard the word MERP in their life. Hit subscribe and flip the bell to all, because this channel is your archive, your private library of every trap the system hopes you walk into blind. And if you are watching this on behalf of a parent, a spouse, or yourself, keep watching, because in the next 60 seconds, I am going to name the 5 accounts that disappear first under the look-back, and one of them is sitting in your name right now. Now we get to the mechanism nobody explains. Listen carefully, because what I am about to show you is the kill list. These are the 5 accounts the state targets first under the 5-year look-back, in this exact order. If your name is on any of them, the clock is already ticking, and you may not even know it. Account number 1, the joint bank account with an adult child. Picture this. You added your daughter to your checking account 10 years ago, just in case something happens. Maybe a bank teller suggested it. Maybe your neighbor said it was the smart move. It felt safe. It felt loving. Here is the part they hide. Medicaid counts 100% of that joint account as your money. Not half. Not the portion you deposited. All of it. Even if your daughter has been depositing her own paycheck into it for a decade. And it gets worse. If your daughter has ever moved money out of that account, even her own money, the state can flag it as an uncompensated transfer. That triggers a penalty period. In Ohio, the average penalty divisor is around $7,500 per month. So a $60,000 transfer your daughter never even knew was a transfer creates an 8-month window where Medicaid pays nothing. You pay, out of pocket. This is not a glitch. This is the design. Account number 2, the traditional IRA or 401k in the sick spouse's name. This one is the silent killer. In most states, a traditional IRA owned by the spouse applying for Medicaid is treated as a countable resource. That means the full balance must be spent down before benefits begin. A $240,000 IRA? Gone. Liquidated. Taxed. Spent on nursing home bills at roughly $11,000 a month until it hits the state's resource limit, which in many states is just $2,000. And here is the cruelty. When you liquidate that IRA, every dollar comes out as ordinary income. That can spike the healthy spouse into a higher tax bracket, trigger IRMAA surcharges on Medicare Part B and Part D, and detonate provisional income on Social Security. You are taxed on the way down into poverty. Nobody told you this. Before I show you accounts number 3, number 4, and number 5, which are the most dangerous of all, I need one thing from you. Drop a comment right now with your age, your state, and whether you have a traditional IRA over $100,000. Just 3 pieces of information. The comment section is the field hospital. We build the map together. Account number 3, the revocable living trust. This is the one that breaks people's hearts. You paid an attorney $2,500 to set up a revocable living trust. You moved your house into it. You moved your brokerage account into it. You felt protected. You are not protected. A revocable trust offers zero, and I mean zero, protection from Medicaid. Because you, the grantor, can still revoke it, modify it, and pull assets back out, the state counts every penny inside that trust as a fully available resource. The trust avoids probate. It does not avoid Medicaid. It does not avoid MERP. In many states, the house inside a revocable trust is still subject to estate recovery after the second spouse dies. The trust your lawyer sold you is a probate tool. It is not an asset protection tool. Those are 2 completely different things, and the industry profits from your confusion. Account number 4, the life insurance policy with cash value. Most people have no idea this one is on the list. If you own a whole life or universal life policy with a cash surrender value above $1,500 in most states, that cash value is a countable Medicaid resource. The state will require you to surrender it, borrow against it, or assign it before benefits begin. Decades of premiums you paid faithfully, gone in a single application. Term life is generally safe because it has no cash value. But that $50,000 whole life policy your father bought you in 1978? It is on the kill list. This should make you furious. Account number 5, the transfer on death or payable on death account. This is the trap most retirees walk into smiling. You set up a TOD on your brokerage account or a POD on your savings account so it passes to your kids outside of probate. You thought you outsmarted the system. Here is the part they hide. In a growing number of states, Ohio, Michigan, Iowa, and others, MERP has expanded its definition of estate to include non-probate transfers. That means your TOD account, your POD savings, your jointly titled brokerage, all of it can be clawed back after death to repay Medicaid. The state is not neutral. The state is a creditor, and it sits at the front of the line, ahead of your children. These are the 5 accounts: joint checking, traditional IRA, revocable trust, cash value life insurance, TOD and POD accounts. Every single one is sitting in the average middle-class retiree's portfolio right now, and every single one can be drained, denied, or reclaimed under the 5-year look-back in MERP. But that is not even the worst part. Stop and ask yourself one question. If these 5 accounts are this dangerous, if MERP has been federal law since 1993, if the 5-year look-back has been on the books for over 20 years, why has nobody in your life ever sat you down and warned you? Not your bank, not your broker, not your CPA, not your financial advisor, not the nice young man at the insurance company, not even the social worker at the hospital. Why? Because nobody in that chain gets paid to warn you. Your bank makes money when you keep deposits in joint accounts. Your broker earns fees on the IRA balance. The bigger it stays, the bigger his cut. Your financial advisor is licensed to sell products, not to practice elder law. Your CPA prepares last year's tax return, not next decade's Medicaid application. And your estate attorney, if you even have one, most likely sold you a revocable trust because that is what most general practice lawyers know how to draft. Medicaid asset protection is a specialty. It lives inside a tiny corner of the legal world called elder law. There are roughly 500 certified elder law attorneys in the entire United States. 500. For a country with 56 million people over the age of 65. The math is the message. The system is not broken. The system is working exactly as designed. Silence is the business model. Confusion is the revenue stream. And the certified letter Margaret received in Chapter 1 is the final invoice. This should make you furious. So here is what I need you to do right now, before we move to the defense manual. Save this video, bookmark it, send it to your private library. This is not a casual watch. This is a survival manual. You will want to come back to it the day your spouse gets a diagnosis, the day your parent has a stroke, the day the hospital social worker says those 7 dangerous words. And send this video to one person tonight, not next week, tonight. One married couple, one widow, one adult child taking care of an aging parent, one friend with a paid-off house and an IRA. You may be the only person in their life who ever hands them this warning before the clock runs out. This is the crime scene, and we build the map together. Now let me show you the defense. This is the part you came for. The defense. The exact legal moves that stop the bleeding. Take notes. Pause if you have to. Because every single one of these tactics has saved real families hundreds of thousands of dollars. And the difference between knowing them and not knowing them is the difference between dignity and devastation. Defense number 1. Unwind the joint bank account. Today. If you have an adult child on your checking or savings account, you have a ticking bomb. The fix is simple, but it must be done now. Remove the child from the account. Convert the relationship to a power of attorney instead. A properly drafted, durable POA gives your child the legal authority to manage your money without giving Medicaid the ability to count their name on the title against you. Document every dollar that was theirs versus yours. Bank statements, canceled checks, a written explanation. Build the paper trail before the state asks for it, not after. Defense number 2, the Medicaid Asset Protection Trust, MAPT. This is the queen on the chessboard. A MAPT is an irrevocable trust. Once you place an asset inside it, you cannot pull it back out. That is exactly why it works. Because you cannot revoke it, Medicaid does not count it as an available resource, as long as it was funded more than 60 months before your application. That is why the clock matters. AMAPT funded today protects assets in 2031. AMAPT funded after a diagnosis protects nothing. You can place the house inside a MAPT. You can place brokerage accounts. You can place cash. You retain the right to live in the home for life. Your children are the remainder beneficiaries. And critically, the assets still receive a full step-up in basis at death under IRC Section 1014, meaning your kids inherit with the capital gains tax wiped clean. This single tool, used correctly, protects more middle-class wealth than any other strategy in elder law. Defense number 3, the Lady Bird Deed, Enhanced Life Estate Deed. This one is criminally underused. A Lady Bird Deed lets you transfer your home to your children at death without giving up control during life. You can sell it, you can mortgage it, you can change your mind. And because the transfer happens at the moment of death, not before, it is not considered a gift under the 5-year look-back. In states that recognize it, Florida, Texas, Michigan, Vermont, and a handful of others, a Lady Bird Deed can shield the home from MERP entirely, because in those states, MERP only reaches probate assets, and a Lady Bird Deed bypasses probate. In Ohio, the equivalent tool is the Transfer on Death Affidavit for real estate. In California, it is the Revocable Transfer on Death Deed. Different names, same weapon. Ask an elder law attorney which one your state honors. Defense number 4, the Medicaid-compliant immediate annuity. Here is the move the wealthy use that nobody talks about. When one spouse needs nursing home care and the couple has too many countable assets, a Medicaid-compliant immediate annuity can convert a lump sum into an income stream for the healthy spouse. Because the annuity is irrevocable, non-assignable, actuarially sound, and names the state as a remainder beneficiary in the correct order, it is not counted as a resource. The healthy spouse keeps the income. The sick spouse qualifies for Medicaid. The community spouse resource allowance is preserved. This single move has saved hundreds of thousands of dollars for couples sitting on $400,000 to $800,000 in assets who were told they had to spend down everything. They did not. Defense number 5, restructure life insurance and TOD accounts. For cash value life insurance, 3 options exist. You can convert it into an irrevocable funeral trust, exempt in every state up to roughly $15,000 in most jurisdictions. You can transfer ownership to an adult child more than 60 months before applying, or you can surrender it strategically inside the spend-down window. For TOD and POD accounts, the answer depends on your state. In Florida, MERP recovery is limited to probate assets, and the homestead is constitutionally protected from creditors. So a TOD account on non-homestead property is high risk, but the home itself is generally safe. In Ohio, MERP has been expanded to reach virtually every non-probate transfer, including TODs, joint accounts, and life estates. Ohio is one of the most aggressive recovery states in the country. AMAPT is almost mandatory. In California, recent reforms have rolled back estate recovery dramatically. As of 2017, California recovers only from probate assets, meaning a properly drafted living trust, or TOD deed, can shield nearly everything. Same federal law, 3 completely different battlefields. Geography is destiny in Medicaid planning. Defense number 6, the 60-month clock itself. Here is the truth nobody says out loud. The single most powerful Medicaid planning tool in America is time. Every day you wait is a day the look-back window keeps the asset exposed. Every day you act is a day closer to safety. The clock does not start when you get sick. The clock starts when you transfer. So the cheapest, most powerful move you can make is to start the clock today. Before the diagnosis, before the fall, before the stroke, before the certified letter. Now, drop a comment below and tell me which of these 5 accounts scares you the most. Number 1, 2, 3, 4, or 5. One number. Drop your field report. The comment section is the war room, and your answer helps me build the next warning bulletin for someone exactly like you. And now the math gets ugly. Let me show you the math. 2 families, same state, same assets, 1 difference. Family A, the Holloways, Margaret and Walter, $340,000 home, $240,000 traditional IRA, $80,000 joint checking traditional IRA, $80,000 joint checking with their daughter, $50,000 whole life policy, $90,000 TOD brokerage account, total $800,000 in middle-class wealth built over 40 years. No MAPT, no ladybird deed, no elder law attorney. Walter enters the nursing home. 22 months later, MERP recovers $312,000. The house is liened. The IRA is liquidated and taxed. The TOD account is clawed back. Margaret is left with roughly $180,000, a 77% loss. Family B, the Bennetts, same exact assets, same exact state. But 6 years before the diagnosis, they spent $6,500 with a certified elder law attorney. They funded a MAPT with the house. They executed a ladybird deed. They unwound the joint account. They converted the cash value policy into an irrevocable funeral trust. When the husband entered the nursing home, Medicaid paid from day one. When he died, MERP recovered $0. The wife kept $780,000. Her children inherited the home with a full step-up in basis. Same starting point, $600,000 difference, one decision. This is the trap, and this is the escape. Listen to me carefully now. The 60-month clock is not theoretical, it is mechanical. It starts ticking the day you transfer, not the day you need care, not the day you get diagnosed, the day you act. If you are 65 today and you act this week, you are bulletproof by 70. If you are 70 today and you wait until 75, you may have nothing left to protect. Every month you delay is a month the state keeps the key to your front door. Before the stroke, before the diagnosis, before the fall, before the sale, before the funeral, before the certified letter lands on your kitchen table the way it landed on Margaret's. The clock is already running. The only question is whether you started it on your terms, or whether the state will start it on theirs. So here is what I need from you. Right now, not tomorrow. Smash the like button. Every like pushes this warning to one more retiree who has never heard the word MERP. Hit subscribe and flip the bell to all, because this channel is your archive, your private library, your survival manual against every trap the system hopes you walk into blind. Save this video tonight. Send it to one married couple, one widow, one adult child caring for a parent. Drop your field report in the comments, your age, your state, and which defense you are starting first. And remember the one line that should follow you out of this video and into every conversation you have this week with someone you love. The state is not neutral. The state is a creditor, and the clock is already running. Move the accounts, start the timer, protect the house, before it is too late.